let's take a look at the new ETF here. It's iShares Core High Dividend ETF. All right, ticker symbol HDV. Okay, this is the ETF focused on the dividend return, used by the retirement company, retirement investment fund, help the retiree to getting an income at the same time also get some capital appreciation. All right, let me get the disclaimer away first. I'm not giving any investment advising. Everything I said does not constitute investment advising. If you want to invest, you have to take the risk on your own and do your own homework and research, decide what to invest. Okay, fund description: iShares High Core ETF, seeking a tracking index composed high dividend yield ETF. Dividend yield US equity, US stock. Stock is same as equity. Fund offer low cost to seeking income through US equity. So this is tracking all the US company. Most company is a larger company, larger cap company in the United States. Looking for those large company consistent pay the high dividend year after the year. So this is focus on the dividend, focus on the income. Okay, here is a chart for hypothetic $10,000 return. If you put 10 grand on March 11, on the March 26, you get about 50 grand back. It's not bad, but it's not bad at all, but it's not as good as S&P 500. And just like they said, it's focused on the income and the dividend. So capital appreciation is the second. All right, there's not too much capital appreciation like the ETF focus on the growth. If you focus on small cap growth, pretty much everything return is coming from the capital gain appreciation, capital appreciation instead of dividend. Here is focus on the dividend. Okay, calendar year. Okay, you can take a look. 2021 is 19%, 2022 7%, 23 1%, 2024 14%. You see, there's not too much. In some years they have very low return, but there's no negative return in all these years because they are a very conservative company they are invested in. Most of those conservative companies like to pay a high dividend to keep the investment, keep the investor in, instead of jump out during the bad time. So take a look at the annual performance. Annual performance here, 1 year you get 15%, 3-year average 13%. Look at the 10 years, 9%. It's pretty much the same as like a total stock ETF, like the S&P 500. In the long run, S&P 500 pay about 9% per year for past like 30 years, 40 years. So the risk is very adjusted because you not only get a capital gain, little bit of capital gain, but also a consistent dividend payout. So that's why we call it dividend income. So it's perfect for the people does not have need a regular income to support their standard of living, like people in their retirement. So they cannot take too much risk, continue investing like a small cap growth. They should focus more on the dividend payout during the retirement. So they will try to conserve their capital at the same time getting a certain dividend payout during the retirement. Okay, let's take a look at the holding. ExxonMobil, Chevron, Johnson & Johnson, all those companies. The first two are energy company. Right now, the energy company is doing pretty well, but at the same time, they also pay out a good dividend. So that's a win-win situation. So Johnson & Johnson pay out a pretty good dividends as a pharmaceutical. Procter & Gamble, dividend, high dividend company. Coca-Cola, those are very conservative Home Depot company pay out consistently pay out high dividend compared to those like for example those mid cap and small cap. Small cap pretty much don't pay dividend at all. They invest everything back into the company. Those companies like Coca-Cola, you can see Coca-Cola is everywhere around the world, almost everywhere, in Asia, in Europe, in Africa, everywhere, in South America. So they pretty much matured, those companies. There's no marketplace to get into. I mean, it's everywhere already. It's worldwide. So they are grow very slowly. It's larger company. So they decide that the company high up will decide. For those mature company, they will keep the dividend to pay out to give to the investor instead of reinvesting to back into the company because there are not much room to grow. It's too big already. Let's take a look at the sector. Energy sector. Energy sector has historically paid a high dividend. But energy sector is also very vital. They can go up or down, very sensitive to a geographic event such as what's going on right now in the Middle East. If the war is over in the Middle East, the energy price will drop down again. The energy stock will drop down again. So it's very sensitive. I don't think it's every time see the price go up, just jumping is not a good idea. You can't chase. All right, you're chasing any stock chasing is bad. Buy and hold strategy is for the long run is good strategy for most investors. Unless you are professional trader, professional option traders, those traders understand how to hedge their investment. So they are not just making one trade. They're also hedging their trade with other trade. So that's getting more complicated. We're not going to talk about this here, but we can talk about option or trading like puts, calls, stuff like that in the future. Okay, Morningstar, 3-star rating. Okay, doesn't mean anything. Asset class, equity, focus on the high yield index, right? Pay out dividend quarterly, trade on the New York Stock Exchange. Look at the expense ratio. Look at the expense ratio is only the management fee is 0.08%. So you invest $100, you only pay 8 cents. That's very attractive. Especially if you have do it by your own, you have to look at the company, look at the balance sheet, look at the dividend history, look at the pattern, everything, and the financial history, income statement, stuff like that. I mean, it's a pretty good deal if you using this index when you only pay like 8.08%. You don't have to do all the hassle. You don't have to do all the research by yourself. That's a lot of research. You're looking for good dividend yield company with good balance sheet. Not every dividend high yield company has good balance sheet. Some just pay extremely high dividend because they have a bad balance sheet. That's the reason why they want to attract the firm. They have trouble getting the money, so that's why they offer very extremely high dividend yield. But that's something you have to be careful about. But right now you got an index, so that's much easier. You just follow the index. They just buy the index, buy the broad market, and you got like 75. So that's enough stock. I mean, at least kind of like a different sector. You got like about 40 stock in a different sector. Diversify investor, you will be diversified enough. 30 days yield, 3%, not too bad. Compare what's you get a CD, less than 2%, right? Equity beta, you have to always look at the CD and the money market to see which one you can get into. Like, I mean, after your retirement, you can put the money into a retirement investment, like the stock market, or you can put it into a CD, like those banking account, checking account, banking account, saving account, CD, stuff like that. But you have to consider there's inflation risk, especially right now. You go to the grocery store, everything goes up. So if you're retired, you cannot afford put everything into a money market. You have to continue to invest. At least the investment, the stock is passing with. I mean, the inflation go up, stock go up as well. They can pricing they get a company when they sell stuff, they can change their price according to the inflation. So that's something the bank cannot do. All right, and the equity beta is 0.45. Okay, less than 1. That's less risky, but doesn't mean that doesn't mean it does not have risk. Every investment has a risk, including even you put it into a CD, it has risk too. All right, and the PB ratio 3.62. That's a little bit high, but it's okay. PE ratio 21. Look, this PE ratio look like a little bit high, but you have to consider these are U.S. company. The U.S. S&P 500 on average has relative high PE ratio right now. So 21 is not that big of the deal, as long as they consistent with the market. All right, you don't want to have a PE ratio 21 when the average S&P 500 has a PE like 15. That would be bad. For dividend stock should have a relative lower PE ratio compared to like growth stock, in the large cap growth stock. All right, and the standard deviation 11%, number of the shares 75. All right, this is the iShares Core High Dividend ETF, ticker symbol HDV.